This John Lothian News video is sponsored by
The OCC was designated a systemically important financial market utility in 2012. That led to some big changes at the organization, along with challenges in risk management and credit and liquidity resources. John Lothian News spoke with John Fennell, Executive Vice President of Financial Risk Management at the OCC, about what the organization is doing to ensure that it meets these and other regulatory obligations.
So we, as a systemically important utility, need to make sure we continuously have access to liquidity sufficient to run the business so that even in a failure, we can make the obligations of the defaulting member. Within that, we look at our own resources and on an annual basis assess, do we need more liquidity to continue to help our markets grow? We also look at how we're going to source the liquidity. I think a big issue that we've observed is with the implementation of Basel III over time and the liquidity cover ratios, committed credit facilities that Clearinghouse is really relying on from banks is going to become a scarce resource. I think costs are going to be going up in that capacity, and supply is going to be going down. And Clearinghouse is really being dependent on liquidity, need to look at other sources. What we did is looked outside the box and looked at sources outside of the banking industry and looked at areas that wouldn't have the same procyclicality or impact on the banks in a time of a crisis. So we looked at pension funds as another new source, innovative source of liquidity, and worked with CalPERS to implement the first committed repo facility for a clearinghouse with a pension fund. Pension funds don't have the same kind of run risk that, say, a money market fund or a bank will have during a financial crisis. For us, that provides a lot of certainty that in the time of a crisis when OCC might need the liquidity, the pension fund will be there with resources for us and on a long-term basis be a source for us. Options, obviously the big driver from a price perspective, not only change in the underlying price, but probably the second risk factor would be change in volatility, how volatility surfaces might increase, decrease, or change in shape. That's a real important risk for us and something we're looking at implementing later this year, changes so that we can, within our margin model, to capture that implied volatility risk. I think when we look at model changes and changes to how we margin, the part of the process is to protect ourselves from potential exposures, but we want to do it in a way that aligns the incentives and incorporating stresses of implied volatility, for example, within our margin model, incents the members to mitigate or manage their risk to implied volatility. If they don't, they're going to be charged more margin. If they do, they can really, it incents them to hedge that and be prudent participants in the market. What Basel III really is the international policymakers developing a set of principles that all banks should be following. It's really, its intention is to increase the resiliency of financial markets globally. And I think what you find is this manifests itself either within different regulatory organizations that are international, IOSCO, for example, as being one of the main groups that propagate kind of this policy. And the intent is to do that uniformly across all markets, both domestic and foreign markets. So from our perspective, a lot of what they're doing does impact clearinghouses globally. We are trying to stay ahead of those principles that they're looking to lay out so that we can ensure our markets are meeting the standards, the global standards, so that members who interact with us, either domestic or foreign, get the proper capital treatment of dealing with a qualified CCP. And that's really what Basel differentiates a resilient CCP from a non-resilient CCP through this, what we call qualified CCP status. And I think the other complexity is now how those standards get implemented in the different jurisdictions is a complicated issue. There's a lot of discussion around the equivalencies of, say, the Europeans' implementation of these principles versus the U.S. implementation of the principles. And we are very active in several international groups to try to make sure our markets are that the perspective of our markets and the uniqueness of our markets are contemplated as people implement these policies.